In 1974, Congress passed the Employee Retirement Income Security Act, or ERISA. This law laid the ground rules for pension funds, and lawmakers explicitly recognized the danger of holding too much of any single company's stock. To protect workers, they set a hard cap. A pension fund could hold no more than 10% of its assets in the employer's stock. A decade later, the 401k arrived and slowly replaced pensions as the default retirement vehicle for American workers. When lawmakers went the rules for this new account, they left out that 10% cap. Because of that single omission, the 401k you sign up for on day one of a new job is the only major retirement vehicle in the country with essentially zero legal limit on how much of your own employer's stock you can hold inside it. The math is entirely split. Your pension, if you are lucky enough to still have one, is legally protected from concentration risk. Your 401k, the account you are actually relying on to fund your later years, is completely exposed. We can see what happens when that limit doesn't exist by looking at the Enron collapse of 2001. As this pie chart shows, the Enron employee 401k plan was drastically overweight. 62% of every dollar inside the plan was locked up in Enron stock. Right as the stock began to plummet, Enron happened to be switching its 401k administrator. Employees were completely locked out of their accounts. For 2 weeks, they watched the price crash on the news, completely powerless to log in and sell. By the time the lockout lifted 6 weeks later, $1 billion of employee retirement savings had evaporated. The stock ultimately lost 99% of its value. For employees in their 50s who had spent 20 years building a nest egg, the overlap was devastating. They lost their current income and their life savings in the exact same week. You might assume a disaster of that scale requires massive corporate fraud, but the math repeats itself quietly inside the most trusted companies in America. A Congressional Research Service report looked at large blue-chip dividend payers and found staggering concentration. At ExxonMobil, 54% of 401k assets were held in company stock. At Sherwin-Williams, it was 62%. Take General Electric, a company that sat on the Dow Jones Industrial Average for a century. In the mid-2010s, roughly a third of GE's 401k assets were sitting in GE stock. From the end of 2016 forward, the stock plunged 60%, while the S&P 500 climbed by 25%. Employees who loaded up on shares because they trusted the company watched their retirement savings underperform the broad market by nearly 90 percentage points. In 2008, employees of Lehman Brothers learned that even institutions deemed too big to fail can go to zero in a single weekend. A large share of the firm's bonuses had been paid directly in company stock and deposited into retirement accounts. When the firm collapsed, those balances vanished immediately. Behavioral finance researchers call this familiarity bias. Smart, math-literate adults confuse the daily feeling of knowing their workplace, seeing the products, knowing the management, with actual financial safety. Only 16% of employees understand that any single stock is inherently riskier than the overall market. This risk often builds up without the employee making a single active choice. When companies match your 401k contribution using shares of their own stock instead of cash, that position passively inflates. Plans that match in stock have an average concentration 17 points higher than plans that match in cash. The second problem is the menu design itself. 36% of plans that offer company stock impose absolutely no cap on how much of your balance can sit in those shares, and they offer no warning labels to nudge you away from overexposure. This lack of diversification carries a massive invisible penalty. A 2004 academic study calculated the mathematical cost of holding a concentrated position over an extended period. Look at this visual breakdown. If you have $100,000 of company stock on your statement, the risk-adjusted economic value of that position is actually closer to $50,000. The dollars on the screen are real, but the wealth they represent is highly fragile. Because half of that value could disappear in a single bad earnings cycle, the missing diversification literally makes the position worth less than 50 cents on the dollar. When you hold a quarter or a half of your net worth in the company that signs your paychecks, you do not have a diversified savings plan. You have a passive venture capital bet. The main reason workers freeze and refuse to sell their company stock is the fear of taxes. They look at a position that has doubled or tripled and assume that selling it will trigger a massive bill from the IRS. Inside a traditional 401k, that fear is entirely misplaced. A 401k is a tax-deferred wrapper. As you can see in this animation, selling one fund and buying another happens entirely inside that boundary. You trigger zero tax by rebalancing. The tax event only happens years later when you actually withdraw the money in retirement. The second barrier is psychological. People quietly feel that selling their employer's stock is a vote of no confidence or a betrayal of the place they work. Your career is your vote of confidence. Your daily labor is your loyalty. Diversifying your retirement is simply refusing to let one single organization hold both your current income and your future hostage at the exact same time. You can fix this problem this week in 3 straightforward steps. First, open your 401k statement and measure. Add up your company stock, including the unvested match shares. If it sits above 10%, you are in the danger zone. Second, redirect all of your future contributions. Log into your plan and point every new dollar into a broad, low-cost index fund or a target date fund. You don't have to sell anything today. You just need to freeze the snowball and stop adding fuel. Third, the moment your match shares vest, sell them. Roll the proceeds into an S&P 500 or total market fund. If selling the entire position at once feels too emotional, set a calendar rule. Sell 10% every quarter, or sell whenever the position drifts above 12% of your portfolio. If you are still hesitant, run this simple stress test. Imagine your company's stock drops to 0 tomorrow. Look at the rest of your 401k balance. Could you still retire on what remains? If the answer is no, you have a concentration problem. The company that pays your salary is already the largest financial bet you are making in your life. In 1974, lawmakers understood this math and forced pension managers to cap their exposure. Congress never wrote that protection into the laws governing your 401k. You have to write the 10% rule into your own life and enforce it yourself.